Lee, thank you for joining us today to speak about central banks and disruptive technologies. How do you think the withdrawal of central bank money will impact asset prices and why?
Well, I think there's an assumption there will be withdrawal of central bank money. At the moment, there is no withdrawal. The banks are, even the Fed, still rolling over the maturities of all the bonds. The balance sheet is barely shrinking. But yes, I think if you've seen asset prices triple, quadruple, you've seen market multiples of earnings go from 14 to 25 in certain countries. Clearly, if interest rates are higher, because there's less liquidity in the system, which by the way, I don't agree with, there will be, but if there are, I think PE multiples go down. And one of the biggest problems we face at the moment is that the 60-40 model of bonds, equities that we had as a standard over the last 20 or 30 years, particularly a lot of people relied on in 08, where they lost money on equities, but their bond portfolio rallied 20 or 30 points. These levels of interest rates and these levels of stocks, remember we're at higher levels in the stock markets, Western world, and we're materially higher prices in bonds than we were in 08. Any shock to the system that lowers bond prices, lowers PE multiples, will mean that investors will lose more money in this cycle than at any other cycle probably in the history of time. Very rare that we have bond prices and equity prices both at extremely high elevated levels. So any change in multiples, whether caused by the central bank or an exogenous shock, will be very negative for people, and I think people are relying on a 60-40 model is a mistake. The assumption is the error, not the actual implication of the investment bonds.
Are you able to give us an overview of how disruptive technologies such as P2P lending and Bitcoin are radically changing finance?
Yes, look, disruptive technologies exist, always existed. From the wheel to the hydraulic pumps to the laser, everything changes over time. And disruptive technologies have different effects, and sometimes it's not obvious when they come out what the effect will be. One of the things that you look at, and one of the stories I always tell, is the chairman of UPS was talking to the chairman of another bank, and he said to the banker, "What does UPS do?" And he said, "Well, UPS delivers things." He said, "No, UPS tracks things. Sometimes they're being delivered, but what we do is track things." And so what does a bank do? It lends money based on credit ratings of individuals and companies. It has big buildings with staff in it to take deposits, to write up reports, to look at them. That's changed. Even before P2P lending and before Bitcoin, that changed, whereby they actually just took thousands of people, basket them together according to credit score, and repackaged them into loans and sold them on third parties. One of the biggest problems and one of the many causes of the credit crisis was the fact that instead of a banker actually looking in your eye and having a one-to-one interview that took an hour and took a lot of time and money, he just basketed up hundreds of thousands of us together and sold them on with no care and no due diligence of any detail. Peer-to-peer lending is exactly that, but without the fixed cost of the banks. So if you go to a bank to borrow, or you go to a peer-to-peer to borrow, what do you care about? Do you care about the shiny building? Do you care about the staff? You just care about the rate. And the fact you don't have to pay all those rental costs and those overheads, 3-4% probably on a typical loan, you're going to go to peer-to-peer lending. It's a disruptive technology because it is providing the same service on 10, 20, 30,000 loans at a much lower price. And if you can do it at 10, 20, 30,000, you can do it at 40,000, you can do it at 80,000, and before long, you'll be doing it at $1 million, and $2 million, and $5 million. The industry is disrupting. Bitcoin is different in that you currently have a system where if you're a bank, you're an individual in one country and you buy an asset, buy a consumer good, a DVD or anything, right? You often have to pay, there's your bank, there's the correspondent bank in dollars, there's their correspondent bank, there's a credit card company, as well, there's their bank, and then there's the currency rates. All these different legs. Peer-to-peer lending cuts out the middle. And anything under $100, $200, you really don't need the credit card protection. You really don't care if you lose £10 on your DVD through Amazon, whatever it happens to be. So you've got a technology that works at the lower levels. And if it works at lower levels because it's peer-to-peer Bitcoin and it's encrypted, boom, it can work at $200. If it works at $200, it works at $400. And that's how disruptive technology works. It works at a lower level where there is less competition, less needs, and then it uses its profits to attack the higher and higher levels. The same way a big bank that lends $1 million, 5 years later wants to lend $2 million. It's the same business. And eventually the trajectory of the growth of one business overtakes the other. And if you're lower cost, low volume, and you can be lower cost and higher volume, you can destroy it. So disruptive technology is a big problem for finance. Peer-to-peer lending, Bitcoin, some of the foreign exchange trading companies, the ability to use the SEPA system. There's a lot of disruption going in the banking industry. And I think the banking industry, therefore, has margin erosion.
So would you say we're in a P2P bubble, or is this a great opportunity?
No, we're not a P2P bubble because the sheer size of P2P transactions is 0.5, 1% of what's going on the market. Are some of the valuations of Lending Club or Prosper inflated? Perhaps. That's a different matter. But the volume that's going through at the moment is still very, very low. The number of people who actually have ever used a peer-to-peer platform is still very, very low. But everyone that has used one and improved their credit score will go back again next year, and they'll recommend it to 2 or 3 friends, and that's how it will grow. So no, we're not in a bubble. We're in a phase where maybe margins of the rates you're getting on peer-to-peer lending come down a little bit too quickly for my liking. There's been a little bit of chasing of the higher quality stuff, and it's I call it more of a speed bump along the way rather than a pothole on the road rather than a bubble as yet.
Lee, thank you very much.
Thank you very much. Pleasure.